The housing market is completely frozen. From California to Florida and everywhere in between, buyers have simply given up. This isn't just my opinion. New data published by the Mortgage Bankers of America proves this point. The MBA index, which measures weekly mortgage loan applications, just hit 178.2, marking the lowest reading since 1995. In fact, following the most recent peak in 2021, this index has fallen a staggering 82%. One of the worst declines ever. Now, what this essentially means is that nobody is interested in buying a home. Demand is dropping off a cliff due to various factors, most importantly, the insane interest rate rise. And because of this freefall, the housing market is going to get very interesting this winter. Now, this isn't getting reflected in prices just yet, but there are some strange developments happening as we speak that may be pointing to an ugly winter. You see, when demand is this low, the only way for prices to remain stable or go higher is for the supply of homes to also match the low levels of demand we are seeing. This has been the case for a year now, as supply levels have indeed remained equally as low. When supply and demand are in balance, prices are also stable. But here's the problem. We have now reached a point where demand is so low that really there isn't much lower to go. On the other side, supply is gently increasing. Now, if you look at the current active inventory, which tells you how many active listings there are in the United States, you'll see that while it's historically low, it may be changing very soon. Right now, there are 534,000 homes for sale, which is actually around 5% less than last year. Now, you may look at that stat and say, well, there you have it. Supply is low, demand is low. What's changed? It's the same story as last year. There will be no crash as both variables, supply and demand, are equally down. But that's not necessarily true. Things are starting to change quickly. You see, what we have to look at is a stat called months of supply. This stat, I argue, is the most important one when we observe the housing market. This one tells the tale of the future, and right now that tale is starting to look like a nightmare. Months of supply takes how many homes are for sale, then divides that number by the number of sales. In simple terms, this means you can have a market that has 10 houses for sale in a given month, but only one sale per month. That would mean that this market has 10 months of supply. It would take 10 months to exhaust the available inventory. Now, if we look at months of supply from Redfin data, you can see that it's headed up, way up, on track to beat the mini crash we experienced last winter. Right now, the number stands at 3.1 months, but it's quickly increasing, and as sellers panic and dump inventory into this weak demand, this stat can quickly rise exponentially, and when that happens, you get massive price cuts and blood on the streets. In summary, you can have a crash with low supply. It's all a matter of how much demand there is, and right now, demand appears to be at near all-time lows. You see, housing faces a massive issue known as low liquidity, which means that it can be challenging to buy or sell houses quickly and easily. This is a problem that is inherent to the market even in the best of times. When you, for example, purchase $100,000 worth of Apple stock, you can buy Monday morning and sell Monday afternoon with no problems whatsoever. Not only will this transaction happen quickly, the price will stay somewhat similar, and during the day, you'll know exactly how much your asset is worth as it's constantly trading throughout the day. Real estate is nothing like this. We base real estate prices on an unreliable formula. A lot of people or investors will come up with a value for a house or a condo based on a previous sale that may have happened months ago. So you, Tom, may think your house is worth $500,000 because your annoying neighbor sold it for that much earlier in the summer. And of course, your home is 2 times nicer than his, so it must be that your home is worth at least that much, if not more. And on top of this, your home's value is oftentimes based on just a couple of these neighborhood sales. If you can convince just 2 buyers to overpay for 2 homes near you, this will effectively reprice your entire neighborhood. Real estate operates under the law of the vital few. Just 2-3 transactions can dictate the values for hundreds, if not thousands, of properties, and this opens up real estate to massive issues. When demand is as weak as it is now and supply is as low, all it would take would just be a few transactions to cause massive price movements in the market. This is scaring a lot of leaders in the real estate space. Everyone like this mentions how the market is frozen, but how does the frozen landscape eventually lead to a crack and a collapse? Well, the way we get there is right in front of our eyes, but few want to acknowledge it. The start of the crash will coincide with the start of this. And before I reveal it, please just take 1 second to hit that like and subscribe button if you're enjoying the video thus far. Every like is a massive boost for the channel, and I would greatly appreciate this small quick gesture. Now back to what I was saying. Right now, we are in what's called the speculation and fear phase of the crash. Investors and speculators often thrive in markets with low liquidity and rising prices. They love to engage in frenzied buying and selling driven by the fear of missing out. This speculative behavior further distorts prices. The part where the crash begins is oftentimes the peak of this greed. If we quickly look at the last crash, '08, you can see that in cities like Las Vegas, the highest greed came right before the massive reversal to the bottom. And this part up here is exactly when everyone was scared of what was in front of them. Right now, there is a lot of fear in the market, but this incentivizes speculators to keep pushing, as oftentimes right now is where the big money is made. It's right before the music stops, but when the music stops, we will enter the surprise reversal. A few high-profile transactions or news events can quickly change the perception of the market. Once the sentiment turns negative, it can trigger a rush to sell, causing a sharp decline in prices. We've had very low unemployment for years now and economic conditions that have remained resilient despite massive challenges thrown our way. But as time goes on, this will eventually give in, and when it does, it could be the catalyst that finally changes the perception of the market, as sellers forced by job loss will quickly add to the extremely low inventory count. When this happens, the final phase will begin, the domino effect. As prices drop, a chain reaction is triggered. Buyers who purchased at inflated prices may find themselves underwater, leading to distressed sales. This, in turn, can lead to further price declines. As the negative feedback loop accelerates, investors begin to panic sell, and those looking to get out begin undercutting one another. A race to the bottom that can quickly become a bloodbath for values. We also saw this in '08. Going back to that Vegas chart, you can see that once the market turned, prices began a free fall, falling over 30% in some years. For example, from August of 2007 to August of 2008, on average, a typical home lost over 31% of its value. This part here is the pop of the bubble, and it only happens when fear and greed reach unprecedented levels. Today, we find ourselves in an environment that looks more and more like this, and knowing when the turn is coming is very hard to predict. But the signs are there. It's just a matter of finding the catalyst. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and don't forget to leave a comment below letting me know what you're seeing in your local market.